Hello, welcome back to the Hoop Scoop, and we are starting video number 6, and we're going to be digging into what investments are best for income in the stock market. So, once again, the purpose of these videos are primarily to help my family be able to manage and grow their cash flow in the event something were to happen to me if I should pass away. And this is just sort of walking through how I think about investing in the stock market at my current point in time. Now, presently, my family is trying to build up cash flow because we have a baby on the way, and we would like my wife to not need to work as much. Preferably, allow her to stay home. So, I am focused on asset classes in the stock market that create cash flow, and these are all the asset classes, or 7 of them, that I know of in the stock market that are reliable sources of cash flow. So let's dig into them. Now, the first most obvious one is dividend-paying stocks. Plain old vanilla dividend stocks. These are classic. Everyone loves them. Well, most people love them. There are actually growth investors out there who despise dividends. But in general, people appreciate stocks that pay dividends. It means your company, by and large, is making profit, because that's what all healthy dividends are paid out of. And you get potential for those dividends to grow over time, assuming the profits grow. And a healthy company is usually paying anywhere from 1 to 5% in dividends, which can be very, very nice. Now, the second asset class, I'm just going to categorize as pass-through securities. And there's several different varieties of pass-through securities. The most popular ones are Master Limited Partnerships, or MLPs, Real Estate Investment Trusts, or REITs or REITs, Business Development Companies, which are abbreviated as BDCs. And then a lot of people don't realize this, but all ETFs are required to pay out 90% of any capital gains that they receive throughout the year. Capital gains or dividends. So, that rule applies to all pass-through securities, which is why I have ETFs in the pass-through security section here. And so MLPs, Master Limited Partnerships, most of them are in the oil and gas industry. And so you get a lot of infrastructure projects, a lot of well drilling projects and whatnot that are Master Limited Partnerships. And they often pay 5 to 10% as a dividend or distribution. Real estate investment trusts can pay anywhere from 3 to 10%, and they come in a few varieties. You've got real estate investment trusts that buy and hold physical property. Then you've got real estate investment trusts that lend mortgages. They create mortgages for purchasing property. And then business development companies, all they are doing is lending money to businesses. They can do stock deals, loans, debt structure deals with companies that need capital, working capital. So BDCs generate 3 to 10% in dividends as well. And then ETFs, the universe of ETFs is massive. So not all ETFs will actually pay a dividend, which is why I have it listed as 0 to 60% in dividend distributions. However, the ETFs that do pay distributions, you can get some that pay 3%. You can get some that pay up to like 60% for some of the covered call ETFs. But that's getting ahead of ourselves. So, and then you've got bonds. There's a lot of bond funds and you've got the bonds broken down into federal, municipal, and corporate bonds. Typically, you're going to get the most, the coupon is the interest rate. So you get the most interest coupons off of corporate, because that's a little riskier, 5 to 8%. And then you've got municipal which is around 5%. And then federal, which right now is around 4 to 5%. And then closed-end funds are the next asset class that a lot of people don't know about. Closed-end funds are very interesting investment vehicles. There are a lot of advantages to closed-end funds. However, you do have to be careful with them because closed-end funds can charge higher fees to manage money. However, the fees are built into the entire package, and they can have some really nice distributions from 3 to 20%. Now, the thing that makes closed-end funds unique is typically with most ETFs and open like mutual funds, you're going to have investors, when they put money into them, the ETF or the mutual fund receives that cash and they create shares that they then give to those investors that represent that investor's investment within the fund. And then when those investors choose to sell, they then sell the asset that the mutual fund or ETF is holding, redeem it for cash, and return that cash to the investor. So it's an open fund because cash can flow into the fund and is then used to purchase the assets. And then when cash flows out of the fund, those assets need to be sold, and that cash is redeemed and given back to the shareholders. Now, a closed-end fund operates completely differently. They raise funds on the market once. So money comes into the fund, and then they begin managing their investments. And then when investors go to sell out, instead of selling out to the fund, they're actually selling out to other investors that are looking to buy into the closed-end fund. And this creates an interesting dynamic because you can have instances where the value of the closed-end fund investments is greater than the actual price that the shares are trading at, which allows you to get some interesting discounts on assets from time to time. And that's simply because the assets themselves aren't being sold by the fund every time investors are buying and selling out. And so closed-end funds are handy because you can employ a very sophisticated strategy, and then you do not need to worry so much about investors pulling their money and having to divest from that strategy over time. That can cause issues for investment managers as far as liquidity goes. And anyways, that's neither here nor there, but I just thought it'd be interesting to point out. Anyway, closed-end funds, they can be very fun. You do want to be careful to make sure that you are picking a good closed-end fund with a good track record now. Then you've got collateralized loan obligations. I have been learning about these. I'm very interested in them. It's literally just a package of loans that they package a bunch of loans together that they lend out to businesses that need capital. You have protection on those loans. Whenever money is lent to a business, those borrowers have a higher order of security than the shareholders of the company. So if the company were to go bankrupt, they would sell off all the assets to pay back all the debtors. And then anything left over goes to the shareholders. So technically, a collateralized loan obligation would be lower risk than investing in straight stock. But there's still risk there. The nice thing with collateralized loans is you get a nice interest rate paid out regularly. And so they do have some CLOs. I haven't seriously looked at CLOs yet, but it is definitely on my shopping list eventually. It's not something that I think is necessary, but it can be a great way to diversify. Then the options premium selling strategies. This is the sixth out of 7 ways to generate cash flow in the stock market that I am aware of. And you can have a self-managed option premium selling strategy where you yourself are managing it. That requires a lot of time and can be very stressful to manage. Or you can hire it out through an ETF managed service provider, such as YieldMax is the most popular one, I believe. So, and these can have anywhere from 7 to 60% distribution rates, depending on who is managing it and how they are managing it. So, for self-managed, I found the style that I like to do can generate probably 50 to 70% distribution to myself in cash flow. So possibly more than that actually, but it's hard to track, and it just depends on what the market's doing and how much premium you're able to collect. In this strategy though, you are primarily selling options and collecting more premium. And then the way I like to manage my strategies, I buy options to hedge out my directional risk. Other people, they like to buy a long-term option and sell short-term options against it. I actually buy both a call and a put straddle, and then I sell a short-term strangle against it that I roll on a daily basis to collect premium. So, let's see. And then we've got preferred shares. That's the last and seventh asset class that you can generate a lot of cash from in the stock market. The way preferred shares work, it is as if the business is borrowing money, but instead of borrowing from a bank, they are borrowing from investors. And so they raise money and sell preferred shares for, let's say you sell 1,000 preferred shares and you sell them for $100 each, and so you end up raising $100,000. Those shares, now you say you're going to pay a dividend of 5% on those shares each year, and you are required to pay that dividend. However, at any time, you can call those shares and buy them back from the investors for that $100 that you initially raised it for. So you're receiving capital, you're paying a distribution on that capital as the business to the investors. And then when you no longer need that capital or generate your profits from whatever investments you made, you can buy back those obligations to distribute cash. Now with preferred shares, you want to be very careful. The dividends are safer than regular dividend stocks just because you have a preferred stock. And so you are higher up the scale in terms of who gets paid a dividend when. However, it is a callable investment, so that company can close your trade at any time. They can just buy you out. Now, when they buy you out, you get all your money back, plus whatever they paid you in dividends over the time period that you held it. So that can be a very sweet deal. The thing with preferred shares, the price of those shares does fluctuate over time. So if you see that these preferred shares are callable at $100, you probably don't want to buy the preferred shares for more than $100, especially if you think they could be purchased back at some point. And so if you see you can buy it for, let's say, $95, and then you collect your dividend, and then they eventually call it back, you get that the full $100 back, but you bought it for a $5 discount. Those are where preferred shares get very interesting to me. But preferred shares are complicated enough. There's enough moving pieces where I'm not interested in pursuing them at the moment. So all I'm doing here is laying out all the different types of investments you can make. So now, where are we investing right now? So right now, all of our funds are going into options premium selling strategies. So I am managing one strategy myself. And then the rest of our money is all in ETFs with YieldMax. I think we have, it's all YieldMax and Defiance. I'm not sure that we have anyone else. So that's where we've invested our money at the moment. And we are generating enough to offset if something were to happen to my job at this point, our family's good. But we need to generate enough to replace my wife's job. So when our child comes, then she no longer needs to work. So we still got a little ways to go for that. So in any case, so that's a good overview of all the different asset classes for cash flow in the stock market. If there are any others that you guys think of, feel free to put them in the comments. Thank you very much for listening, and I guess please like and subscribe. I don't know if you're supposed to say that at the beginning or the end, but whatever. In any case, have yourselves a good day.